All right. Good morning, everybody. The auction today is the 30-year, the 10 and the 30, and those two really are, the most important. You're not supposed to say that. It's like saying that one of your dogs is more favorable to you than another dog, or you love one cat better than another. But the 10 and the 30 are the pretty big deal. Yesterday the auction went really good on the 10, and so we didn't really see anything out of it. Um, I guess that's a good thing, right? If it hadn't been good, things would have been really bad. That's like watching NASCAR just looking for a car wreck instead of, who's going to win the race. I'm not saying, you shouldn't do it, but check your motives. Hong Kong is down today 2%. Europe is up more than 0.5%, looking really good, all things considered. Japan near 0.5%, and the rest of the markets, especially like the U.S. markets, Dow is flat, UK flat, S&P just 0.1%, the Nasdaq right behind it, and the small caps down the most, slightly more than 0.25%. So all things considered, we're looking pretty good today. One of the things that we have to worry about in the bigger picture is the jobs data today. Now, the Fed has made it really clear that they're not interested in a March cut. So unless the economic data gets so bad that they want to play save a hoe and cut, we're not looking at a cut. I think the real discrepancy here was back in November. Everybody focused on the dot plots and said, "Oh, look, they're really leaning towards a GP cut, what I call just general purposes, like just because." Remember what the Fed raised rates for? They were trying to get slightly above neutral territory. I mean, that sounds like a lofty goal. Unfortunately, there's no way to tell what neutral is. That's a mythical creature, like a unicorn. So if you don't know where neutral is, how do you know how far to raise rates? And so they raised rates to a spot that they thought was mildly restrictive. And back in November, there was this subtle hint that they had perhaps raised enough and that they could cut back, not because of any economic deterioration, but just because, like, well, we're doing good. We'll just knock it back a little bit. Well, they took that away again. And it wasn't like they promised it anyways. It was in the dot plots, and the market sniffed that out, saw it, latched on it, and really started pulling those rate cuts forward into March. And now that's been taken off the table. So there's no cut on general principle for March. There would only be a cut in March if there's economic deterioration, which would warrant a cut. And we would start to see that in the job numbers, which makes the job numbers relevant to the whole discussion of, will we get a cut in March or in May? Because deterioration, usually starts a little bit at a time and then it just kind of snowballs and gets worse. So we're getting initial jobless claims. Non-farm payrolls is a lot bigger of a deal than initial jobless claims, but it's a canary in the coal mine. It's certainly something that the market is going to pay attention to. And then to round the week off, we have OPEX next week, right? It's the third Friday of the month. So OPEX next week on the 16th. We're a little ways away from that still. But there's not much in between all of that when it comes to this question about the rate cut or the lack of a cut. The 30-year is going to help us better understand how the market took Yellen and that whole QRA event, which is why the 10-year yesterday and the 30-year today have maybe a little more weight behind them. And it's probably why, we see auctions sometimes have weight and other times they don't. The 30-year today is at 1 o'clock. Can't really miss it. We have the front end of 4-week auction at 11:30. Otherwise, we've got a lot of central bankers from Europe, US, and we're going to get more data out of Japan tonight. Japan made that breakout, and it looks like it wants to challenge last year's high of that 152 area. This is still a threat for intervention out of Japan. So I know it doesn't get much, attention, because it's just like watching a NASCAR race looking for a train wreck. But if they do come in and run an intervention, that is tailwind to the S&P and the NASDAQ. So, I mean, that's a good thing, supposedly, right? Because we've seen in the last week, the dollar make big moves to the upside and the 10-year make big moves to the upside at the same time. The S&P and the NASDAQ were making big moves to the upside. So we can say supposedly an intervention for Japan would be a tailwind to the S&P, but yeah, but so yesterday was supposed to be a hurry up and wait. We were going to wait for the 10-year. We were expecting a sideways market, and instead, Fed speakers starting in central bank out of Europe popped us to the upside even before the open. And then we had more Fed speakers that started chipping their teeth around 8:30 that continued to pop us all the way up into lunch, sideways into the 10-year where the news wasn't bad, so we didn't tank, and we just kind of held the line and went into the close. There wasn't a whole lot of push in there, right? But this 5,000 call wall is something that is talked about quite a bit in the founder's note at Spot Gamma. So we're looking at the ES. In their article that they wrote, they were looking at the S&P, the SPX. The SPX did not breach 5,000, at least on the day that they were looking at in the article. It was Tuesday's analysis that they were digging through when the S&P was really just failing to get through that 5,000 level. Right? Maybe it was yesterday. So we can see 5,000 here. They're not there yet. And the call wall is still there. They didn't roll it up. That's bearish that they did not roll it. I'm going to just put that out there that the lack of them rolling those calls up is, in my opinion, a bearish situation, because if they were bullish, they would get those out of the way. The fact that they didn't kind of leans us to the idea that they don't want to make that move before the OPEX. They want to just go ahead and get into next Friday. So if they're going to leave that there, it becomes a major impediment to any continued move to the upside. Got to get through the call wall. There's two ways that can happen. The market can push it there anyways and force them to roll it, or at least just to monetize those options. But it's called a wall for a reason. They're already willing to monetize those options. In the article, they were talking about close enough. So if we see, like yesterday, when we got anywhere near it, they were more than happy to sell out of it. Right? Think about you being long calls and we get up into this zone. Are you going to stick to your guns and get right to the wall before you close? Or are you going to close before the dude next to you closes? Right? You're going to try to beat the rush and say, it's close enough. I'll just close it right there. Well, that's what everybody else is doing too. So when we get a bunch of closes, that's like a negative pressure pushing the market back down. There's a bunch of selling going on up here. What do you think is going to happen? We're going to go down. So the selling isn't enough to, send us falling like a brick tossed off a building, but it is a headwind that stops us from really rallying through that zone. And it's still there. This isn't yesterday's level that we're looking at. This is today's level. I've already imported all the data. So can we get above here? Yeah, but it's going to take, I think it's going to take more than a couple of Fed speakers chipping their teeth. I think we're going to need some actual data. One of those data points could be the job numbers today. I just kind of got a feeling it isn't. It isn't going to be enough. So we need something else. And the only thing else that big would be OPEX next week. I mean, we got some CPI and stuff, but is it going to be enough? That's really the counterpoint. So today we could get something out of the 30-year, get a little rowdy and break through there. Can we keep it? Because they're going to sell it when we get there. The volume is light. They're sitting out, but they're not worried. They're not hedging. They're just sitting out. If it was below 60, I would be concerned. We'd go right back out and start digging around for more news. But at 67, we can just recognize that it's light, and we've already looked at the news that we're going to get. Should be okay. We've got an MDP at the moment. It's a missed daily pivot. Sounds just like what it is. We haven't hit the pivot point yet. It doesn't count for today. It counts for tomorrow. The fact, like yesterday, that we had an MDP, that matters today because we did not hit that pivot point yesterday. So today is a reaction function of yesterday not having hit the pivot point. If you've seen the videos on this, then all of this probably makes sense to you. And if you haven't, it's not my strategy. I don't even trade the strategy. I just use it for analysis. You can hit YouTube and just search for missed daily pivots. You'll find some videos on it. Again, I don't trade it, but it is useful for analysis. We are outside of last week's high, so we finally did get our weekly breakout. It's one of the pivot points that we really want to see held at this point. We're getting into the later part of the week. It would be nice if we can sustain this push. But look at the ES since last, October with QRA all the way up into where we're at. And then we just got QRA again, and we're continuing this upside push. Let's just use this. So there's the QRA, and we've continued to go to the upside. There was a lot of discussion that after the QRA data that we got, we were going to get something similar to 2023 first quarter. That was the kind of the idea from a lot of the consensus, that it was probably going to look a lot like that first quarter. And that is not what we're getting, right? QRA came in first quarter of 2023, and we had a little bit more of a pop, and then we just sold off into the March FOMC. Okay, so that's not this. We just continue to go up and up and up and up. So we're going to have to reevaluate now the data that we got from QRA and consider what else it could be. maybe like second quarter, where we came out of here and continued that grind to the upside after a choppy start. Either way, we're riding strong above all of the major moving averages. This is the very definition of health and strength and trend. Whether you're using pure price analysis or you're combining it with moving averages, you can see the slope. They're equidistant from each other and how price continues to ride that high. If you're looking for a short-term short or pullback, use something like the 3-week. Or if you have a smaller time frame, the 3-day. Breaking below that would give you a short-term short for a pullback. $49.65 on the weekly. 5,000 on the daily. 49.99 sounds like a info commercial. Reciprocating VWAP. So we've expanded a wee bit, had capitulation dump. Just measure that distance, shoot it to the upside. That would be your upside target if we're just going to grind lower and lower. Otherwise, looking for a tag of the daily pivot point and then a consideration of S1, S2. From below the daily pivot, we have the previous week's high and the channel for my pivot. The channel is just math, but the size of the channel is important. It kind of reflects the move that we got yesterday. If the previous day is really narrow, you can see like this day was really narrow. The next day's channel was really thin. If the day was really big, the next day's channel is really wide. It's kind of the idea behind it. So we're inside my channel. We haven't hit the pivot point yet. If we break that, get to the bottom half, we got the ADR half on the downside of 49.92. Below that, we got a voodoo line, 49.76. And then the previous week's close. We had the previous week's high. And then we have the previous week's close. Below that, full ADR, and then the 10-day moving average. It's a long ways off. I don't see us getting to any of those levels unless data today just comes in very nasty. And it's possible, but it would be a huge surprise. Nobody's expecting that kind of negativity to come in. So what's more likely? What's more likely is that we get a bit of a half back. We get a little weakness that takes us down to the midpoint here. And we catch some support there, maybe get into the ADR half as an overshoot, and then we hold the line and or rise up even higher. We'll try to retest that call wall. You want to continue to watch that call wall. You can do it on the SPY at 495. You can do it on the SPX at 5,000, or you can do it here using the 5,020. There's trading tick OI, right? You can call the open interest, and you can check the flow to see if they're moving those options off of that spot. Because if they roll those up between now and next Friday's OPEX, we can climb up and keep going. But if they don't roll it up, we're going to continue to just hit our head there. Trading Ticks pointed out that they rolled down the put wall. That's another really bearish signal, that they rolled the put wall down. That's bearish. I post the founder's note every day so you can read it for yourself. They have some pictures. I like pictures. Kind of helps with the visual a little bit. 10-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. We're going to lose more of this volume from the profile point of control over the next 2 days. The only thing that would stop that is if price itself comes back down to the point of control, 49.16. I don't see that really happening. There's so much structure here at 49.50 and 49.60 as a zone. I just see that as a hard level to get through. That will become our new point of control after we lose a lot of this volume from today and tomorrow, because there just won't be enough left to sustain this point of control. So what we want to see is through the day today, if it moves up. And if not, then I guess we'll see it tomorrow morning in the morning briefing. We'll see if it's moved by then. I posted in the Discord. Yeah. I was in a little bit of a rush today. I fell down the rabbit hole coding some pivot points while my NASDAQ trade was taking its slow, sweet time. I was trying to stay busy, keep my hands moving rather than fiddle with my pivot point. So I might not have got the, I didn't post it. My bad. Here, I'll throw it in there really quick. I get it in there every day. Sometimes a little slow, but I do get it in there. It's just a PDF. What I do is I actually print the page to PDF so that all everything that they wrote, the pictures and everything is all there. Because really, the founder's note is fantastic, but you want the pictures, right? Because it's kind of complicated stuff sometimes. So it's in the Discord. Good to go. You should see it now. I just posted it. It was, yeah, it turned out great. Everything was great. Just sometimes trades take a little bit longer than I like, and to keep my hands busy and not move my stop around, I'll find other things to do. And I was trying to code a new indicator for Thinkorswim. Speaking of new indicators for Thinkorswim, Thinkorswim came out with a new indicator. It's not one that we didn't have before because we have community versions of this, but Thinkorswim now has an anchored VWAP that is built in. So if you're, if you work for a brokerage firm where they won't let you add custom Thinkorswim indicators, you know who I'm talking to. You can use this one now because it's not custom. So that's pretty cool. Well, I already had versions of this, and theirs won't let you pick the time, just the day. But still, it's pretty cool if you're using it for equities and anchoring it to individual specific days like earnings, new year, new month, new week. I was looking at Google yesterday, and it's resting on its year-to-date VWAP. Really nice, looking for a push up off of that. So there's new stuff being added to Thinkorswim every day. But I was messing with these SVE pivots. I've got something in my mind for where I'm what I'm going to do with it. No, I didn't post it in my own coaching Discord, but I certainly can. All right, so the point of control is going to move as the point. It's not going to go to the highs here unless we really start getting a lot more volume. I guess that's something to keep your eye on too, right? They can move that call wall down just a little bit, and we can start really racking up the volume significantly right where we are. there's a cog line at 50.11. So it's something to consider. We're already starting to build it out. It wouldn't take too much more. One day of just holding in this zone, and we could build it out enough to challenge the creativeness down here with this point of control. All right, so it's this that we're losing over the next day and a half. And that really is what's sustaining this point of control down here. So without it, we're going to go to this spot unless one of these starts to really build out. And I don't see that we're going to get that much volume unless we start getting some serious like blow off top capitulation style stuff. That's what we want to watch for, though. No VPOC from yesterday. We've crossed through that zone multiple times. I only carry forward the point of control when it has not been touched. But if you go and read profile books and start studying, volume profiles and TPOs, a lot of books will tell you to carry these forward, the value area high and low, and the point of control, whether it's been hit or not. I've already got enough pivots, so I don't bother with that. But it does have a precedent, to have that consideration of where 70% of the volume was, and those levels often become relevant. So, if you don't have enough pivots and you're looking for one, you can consider that, right? Me, I just want the ones that haven't been hit yet. We hit a lot of volume down here, and we did not spend, a lot of time here. So they're certainly coming in to defend this low. But will it be enough? At some point, the way that Traditix laid everything out yesterday, we're trapped between two zones. We had those puts kind of close to us on the downside, and there was just a whole lot of optionality right underneath us. And then we had the call wall above us. Notice I said had, because they moved the puts. So we're no longer so trapped. Remember, I have said before, the market is like something in nature, and you don't compress nature without giving it an out. You have to give it a release valve or it'll explode. They moved the put wall down, so they gave us an out. Now the question is the market going to take it? We're still inside our weekly range. There's two measures that you can focus on, one of them being yesterday's price, which we hit on already once. It's the halfback, 49.95. If we can get below that, we can get back to Friday's close, somewhere around that 49.70 area. And it still wouldn't be, a bearish move on this trend that we've been running. We're still 0.5% from the 10-day. You can see how we're kind of working our way back, but this is just a shuffle, and it's not bearish. Not yet. Even coming back and tagging that 10 and getting a little underneath it, even that's not bearish, because that's just healthy. So we haven't moved too far too fast, and we don't have any bearishness on the daily. We'll flip it to a weekly point of view. Same thing. It's still curving up, and sure, I mean, it's down a negligible amount, but there's no reversal being signaled here. We're 3.7% above the 10-week. We've been higher than that before, but one, it doesn't normally stick. And two, it's usually the curve before we start coming back down again. So what I'm looking for is a spike or a peak at this point. I've got my mouse right now on a spike or a peak, and the market moved about 3.5% on that pop. So, let's check this one. It's worth keeping your eye on that because a 3.5% pop is a pretty good move. That's another 3.25. 2.5, closer to 3. It's a good question, to ask about what's the key things to look for in the report. It's a good question, but look, they're not trying to write an article, an entertaining article. They're trying to relay to you key pieces of information. So they're all important, right? There's no fluff in there. So it's a good question, but the whole thing is literally hitting on every single point of information that they deem relevant. I don't think you would want to look at it and ignore most of it just to try to hone in on one special piece. But are you a day trader? Or are you a swing trader? Are you trading the options on the futures? Are you trading the futures themselves? Are you trading equities? How you answer that question would then be able to help you answer the question that you asked me. What are the key things in this? Because if you're trading equities, maybe these things with the sectors would be important to you. Being able to understand the language of what is written here, the key topics, that would be important to you. So all of it, I guess, is the answer. All right, I took off all the other stuff. Let's just move these for a moment. Without all those levels, it's a lot easier to see what we've got going on. Maybe we could have kept the VWAP, but that's all right. We've already talked about the resistance zone and the call wall and what it represents, that 50-20 level, and how difficult it is that we're gonna be able to get through there. So that leaves us with the market sitting in this choppy range bound zone. And it's already giving us reversal signals, right? Like this 2-bar here suggesting that, we've got a low here and that we're done with. And then we could just rise back up again. And it matches this other zone back here, right? A lot of buyers came in and stepped in to defend that level. So they're defending the 5,000 area, and we've got a lot of resistance at the 50-22 from the call wall. This is a zone that we may stay in today, but like a megaphone pattern, a little bit at a time, we could begin to break that zone. So just because where it was and where it is now, right? If the put wall yesterday was a lot closer, and it was, the put wall was closer to us, that was kind of providing support on the lower end. The very fact that they rolled it down that they moved it out of the way, that's a bearish. It's a bearish action or a bearish activity. Why would they move it lower unless they thought we needed some room to move to the downside? Remember, they want to monetize, right? They want to make money just like you and me. If the put wall is really close to us on the bottom side, then there's really nowhere for price to go. We'll just keep hitting that put wall and we won't fall. You move the put wall down back to its previous location, no less, which is way down here at 45.20. Now, suddenly we have room to move. So by its very nature of having been rolled down, that is a bearish behavior. It's the same with the fact that they didn't roll the call wall up yesterday. They left it in place. That is a bearish behavior. What they would have done if they were still aggressively bullish and seeking a higher move between OPEX, they would have rolled the call wall out of our way. And they didn't. And so the very fact that they didn't roll that call wall out of the way is a bearish behavior. Add that to the fact that they moved the put wall, and I'm even more bearish because of it. But there's a difference between, oh yeah, I'm going to short this sucker, and I don't think we're going up. Those two sentences are completely different, right? So we have a bearish bias because they moved the put wall and they didn't move the call wall. But that doesn't say I'm going to short this sucker. That says I really see a hard road ahead to go anywhere higher than 50.20. Just because we don't think it's going down, or just because we don't think it's going up, doesn't mean we think it's going down. And that doesn't bode well, by the way, for traders over the next week. OPEX is next Friday. What are we going to do for a week? Just chop here in between the volatility trigger and the call wall? I really hope not, because that's going to be a boring, nasty, choppy week. But it's very well what we could get. Yeah, me too, right? I don't want to trade that junk. And usually if it's choppy, I'll go do something else. There's always stock to trade. There's options to trade. I will find something that is offering me something better. But that's kind of the issue right now, which if we lay out our own zone this morning, these two purple levels, then we start to identify the upper edge. We can just consider the whole thing, you know, a zone of selling. And like any megaphone pattern would suggest, we can get up into that 50-20. We can get there. We can wick above it. We can even close above it. But can we keep it? And since liquidity resides on the other side of the pivot, when we get there, and if we shoot through it, that's where liquidity is anyways. We would still expect to fall back down. And now that there's no guardrail, I guess, with that lower put wall, we could fall off the cliff. But what's going to push us to the edge of the cliff? We still have some Fed speakers. We got some jobs data. PPI next week. There's always the threat of intervention with US dollar Japan. China is still dealing with that Evergrande contagion and still making a million promises that they're going to, you know, get it cleaned up. So level by level, if we break our own Globex low, we've got, just from our own measurements here, some levels down to the ADR. We can measure all of yesterday and lay out the 50% mark. Beyond our own ADR half, we got the full ADR basically down at yesterday's low. And don't forget that 30-year auction. It should tie in with the QRA that we got last week from Yellen. I added a new ETF to this group. It's called MAGS, M-A-G-S. I got it in that founders report. Typically, I use different ETFs to monitor the Magnificent Seven. There's a double and triple leveraged FANGs that I tend to keep my eye on. FNGD and FNGU. I look at the volume on those, especially if it's a bullish day or a bearish day. Those volumes in the pre-market are a really good tell for the kind of day that we're going to get. But I had not been monitoring the MAGs. So I threw that in here today. We're going to start keeping our eye on it. These are triple leveraged products. The D is the down and the U is the up. So FNG up and FNG down. That doesn't have an explanation on it that I would expect it to say, but whatever. What we have this morning making moves. Gold miners and the China ETF, but not KWEB, not enough yet. We need more, and not emerging markets, which is basically China. It's supposed to be more than just China, but there's so much of China in it that you might as well just say it's China. But those aren't up enough yet. We need more out of them. But we do have gold miners up, and uranium's almost there. We can call it that too. Those are not the glamorous, sexy tech names. And that China that we talked about earlier, China is down the most this morning, right? So we start here, very first thing in the morning briefing, but it leads here. KRE, KWEB, emerging markets. On the positive side today, we got Bitcoin, semiconductors, communications, but that starts getting us down into not enough, right? It starts semiconductors and Bitcoin. This momentum index was from yesterday, by the way. Big move in the momentum index. So there's a broad middle ground here with nothing. We can't sustain a rally in the S&P on Bitcoin, and we need more out of the semiconductors. They got to get up at least to 0.5%. K-Web is almost at that 0.5% this morning. Looking at TrendSpider, it's nearly there. Pot stocks, which isn't being picked up on Thinkorswim, which is not a surprise. That's why we come over here, right? Just to double check Thinkorswim's pre-market. Yeah, that's not looking overly bullish to me. So pot stocks, Bitcoin, that looks more bullish this morning. We're right up into a high volume anchor. No, what is it? Year-to-date anchor on Bitcoin. Looks like we're actually getting through it onto the other side of it. We're above the mean and above both of those anchors with no trend lines in the way. Solar's up 1% as well, although I gotta say the flows don't look good. Crude or USO also up. This is a really nice wedge pattern. It's like a bearish pennant, but it's a failed bearish pennant. I've traded a couple of those. When you can catch them early, they're fantastic. I wasn't looking at it, so I didn't catch it early. But we traded one of those on Walmart once, and it worked out really good. A couple of measures you can do is just measure the biggest candle. This zone was in control from this candle, so you can measure it and plot your levels up. And then you can also measure this entire leg and mark out your 50% mark. We talked a little bit about US dollar China. This morning it's up to 149 plus some. We're getting that breakout. This is a daily chart here on the right side, and this is a daily breakout on the year. Since we're just considering, what we've done since January, this is a high on the year. In the last 12 months, we've got that 152. So it's not, a 1 year high. It's just a year to date high. But think of US dollar Japan as a proxy for the dollar and the 10-year. If this is going up, then the dollar and the 10-year are expected to be going up. And when the dollar and the 10-year is going up, that's supposed to be a headwind to the S&P and the NASDAQ. We would expect it to not rise, not necessarily fall. It's that same argument as earlier, but it would have a harder time rising if the dollar and the 10-year are rising. So if you want to rally in the S&P and the NASDAQ, you want to see this stop going up. The thing is, that rally, where's it going to come from with that very strong call wall overhead? Got to get some levels here. All right, so I share these levels every day. The one is for spot gamma, and the other one is just for my watch list, the names that are in my watch list. And so if you have the watch list, copy the code. You can create a brand new indicator from scratch. paste it in there. I like to date it so that I know I have a current one. And you get these levels. My watch list has all of the names that you would expect from, like the FANGs and that sort of stuff. So if you go to Microsoft, Tesla, Apple, you're going to find these names there. You're going to find these levels. They get updated every day. So Microsoft was making some pretty big moves yesterday. This is a gap up on the daily. It's also a red to green. And it's a TRB setup all in one. TRB owes us to the top of the range. That's all that it owes us, and we're already there. So it doesn't owe us anything more than that. But usually a TRB is the start of something new. So like a new trend, sort of kind of approaching it from that way. If we measure this really big candle, the 50% mark lines up with the 7-day expected move, that blue line up here. We are IX10. Well, we were IX10 inside of this one big bar that I just measured, the one that's closer to us. So looking at it this way, 415.32 is still resistance. This morning we're down a little bit. We're at 412, call it 413, when we closed at 414. So Microsoft is down just a little bit. We want to see it stay in this zone this morning between 1265 and 1435. We kind of want to see it holding that level. Breaking back down below it isn't going to necessarily be a done deal for negativity, but it just doesn't bode well, right, for a sustained move. We don't expect any of these FANGs to really make a move if we're not going to get that move in the S&P and in the NASDAQ. The call wall for the Qs is in that founder's note. Call it 435, right? Nope, that ain't right. My son is calling. I gotta get off here. He never calls this early. Find out what's going on. Everybody, be careful, be safe. I will talk to you tomorrow.